Okay, g'day everybody. Welcome to our update from the budget and what it means for you webinar. My name is Stu Kendall. I'm the operations leader here at Pursuit Advisors. Lucky enough today to be joined by our HR and PD leader, Paul Pratt. Welcome, Paul. How are you doing today?
I'm well, thank you, Stu, and yeah, thanks for inviting me along and being happy to host this session. And yeah, it's always interesting to have a chat after governments announce their budget. And this year it's back in the traditional May space, where last year we know there was lots of budget announcements.
Yeah, no, thanks very much for coming along, and really appreciate your time and everyone else's time, because we know it's a really busy part of the year and there's lots happening. So I'll start off with a bit of a disclaimer, and that's any advice here is to general in nature, and if you believe that anything here applies to you, please reach out to one of our friendly team members and we'll be more than happy to help out. This info is based on the available updates as of May 25. Nothing here is currently passed as legislation, so there's always the chance of some tweaks and adjustments as that goes through that process. So what we plan to cover off today is an update of the 2022 tax rates. We're going to talk about the federal budget. We're going to talk about the Victorian state budget, which was released as well. And then we're going to chat about some tax planning opportunities for the end of financial year, for those of you who are interested in getting proactive with how this year is going to end for you, as well as the different kind of lodgements we need to meet as next year rolls out. So, Paul, if you're happy to get underway, let's get things started.
Yeah, keen to, Stewie, and thank you.
All right.
And as Stewie said, thanks for taking the time to sit in and listen today. Feel free to throw your questions up and we'll answer them as we go, or at the end, just depending on what the questions are. Now, not specific to either the state or federal budget announcements. However, we thought it'd be worthwhile just confirming some tax rates for the coming financial year. So we've seen a steady decline in the company tax rates over the last few years, where it's currently at 26%, with it coming down to 25% for the 2022 financial year. So that's specific to companies. And then also we just wanted to share individual tax rates, who also we've seen be coming down, especially in that middle band there. So you'll see that threshold, the 45,000 to 120,000, is at 32.5 cents in the dollar plus Medicare, and that depends on income levels anywhere between 1% and 1.5%. As well as Medicare levy surcharge if you do not have private health insurance as well. The plans over the next 4 to 5 years is to effectively eliminate the rate between that 120 to 180,000 bracket, with it end up landing on between 45,000 and 200,000, actually down to 30%. And that kicks in at the 2025 financial year. Not going to go through each of the gradual changes over the coming years, and no doubt, depending on who's in power, they may change that slightly. However, just wanted to flag that for you, because in the end, for small businesses that we work with and clients in that space, it's ultimately the individual tax rates that apply. So even though the company rates are down at 25%, it's once you use that money personally, you pay what we call top-up tax. So for example, if you're paying tax and on a taxable income of 100 grand in your own name, and all that income comes from a company, there will be some top-up tax applicable, because you're at the 32.5% tax bracket versus the 25 that the money's come out of from a company. So it's always good to know what those individual rates are. And I won't talk any more about tax rates, Stu, and I'll throw over to you with some other changes. I believe you're going to chat about superannuation first.
Yeah. So some changes coming up in the superannuation space. This first one's, I suppose, more of a confirmation of sticking to the plan rather than something that's come new out of this budget. So superannuation guarantee, which is what each employee is entitled to based on their ordinary times earnings, that was always going to jump this year from 9.5 to 10%. It's been flagged a long way out, but they've confirmed that, even with the current climate, things are going to change to do that. A key consideration here is that it's all based on the date that the wages are paid. So this year ends finishing on a Thursday. So you should factor that jump in your numbers if your payroll is going to cross that. Because even though half the work week might have been completed before in the financial year, if you're paying in the new financial year, you need to pay that whole amount for that pay run at the new rate. Now, the second one, I'm going to start here with a bit of a personal opinion, and I'm going to say I'm not 100% sold on the application of this one. I like the idea behind it, but not necessarily the way they've gone about it. What they're doing is scrapping the $450 amount you need to tick over before superannuation is payable. Really important that low-income earners and part-time workers do bump up their superannuation balances, but this is going to mean that there's an increase in the administration costs for putting on a new employee, because you might have someone who trials for one day, doesn't work out. You've got to make sure you've got all their superannuation info. You've got to pay them through the super clearinghouse, and I think it's going to be a bit of an admin burden, as well as create a lot of second super accounts for some people, which might also have some impacts for them down the track. So imagine you're a fruit picker, you've got 20 people to start with, you only put half of them on long term. You've got to make sure your onboarding process gets all that data straight away. So for businesses out there, we really want to make sure we're sharpening up our employee onboarding system to make sure we get the right info straight away. And if you need some help with that, please feel free to sing out. And the last one on the screen there is the ability for non-concessional contributions to be made for those 67 to 74 years old. That's scrapping the work test. So you've formerly had to work 40 hours over a 30-day period in order to contribute to super. That test is gone to enable people to top their super up a bit more and get more money into that lower tax environment to help them support them in their retirement. So some great changes, some ways for people to increase their super balances. And yeah, feel free to sing out if you want some more info that's specific to you. Yep. Paul, I'll flick over you to chat about some of the assets changes.
Yeah, no dramas. Thanks, Stewie. So amongst COVID, when we're in full swing of COVID, the government announced that pretty much you could go out and buy new or second-hand assets up to 150 grand and effectively be able to write them off in full as soon as they arrived and become ready for use in your business. They've continued that and extended that right through to 30 June 2023. So effectively another 12 months of that concession being available. So just mindful of those potentially that were rushing around to look to buy assets in the 2021 financial year, may not have had the cash flow to do it or seeking the finance. We now have got a further 12 months to do that, and just re-emphasising that for both second-hand and new assets up to a value of $150,000 excluding GST. Now, there's also been some changes, and they haven't really given us any great clarity about it, and we've even sought some higher powers in the city-based offices around this, and they can't give us any clarity either. So if you are looking to buy new assets over $150,000, we suggest you contact us, and we will explore it on a case-by-case scenario to understand if they are either fully deductible or partially deductible at accelerated rates compared to the traditional SBE, where it's 15% first year, 30% ongoing. I did touch on finance as well, hearing from the brokers that we work with that the days have gone where you can ring up and ask your bank or your broker to get finance for something in the last week of June. We're now seeing turnaround times of 14 days, possibly even 21 to 28 simply for asset finances. So if you are thinking about getting access to that deduction before 30 June, I'd get onto it now. And also mindful that of the wait period out there for equipment. If you don't actually have the equipment landed and ready for use, it's not deductible until it lands and is available for use. So you could buy it now. You don't get it till July. Fully deductible if it's under 150 grand, but not till the July, so not till the 2022 tax year. That's enough on spending money on assets there, Stuart.
Yeah, no spending unless you desperately need it. That's always still the key message.
Mm-hmm.
Now, the budget here was promoted as a jobs budget, so there were some cool things to come out about employment and creating jobs. First up, the extension for the eligible trainee and apprentice rebate. So for those of you who've seen that in the past, that's up 50% up to $7,000 a quarter for eligible apprentices and trainees. This is great for getting that extra pair of hands on site and also for upskilling future generations and a bit of continuity for the business. Anyone who's signed up to the 31st of March 2022 can be eligible for that. So you've got to reach out to your training providers, but also feel free to reach out to us and we'll give you a hand on that application process. There's also some exciting news in the job active area. So with up to 10K for an employer taking on youth, single parents, or long-term unemployed. So details here are a little bit thin. As we get more information on how the application process works, I'll share them through different channels, but please feel free to get in touch in the meantime to see if there's something that might impact yourself. Now, finally, there are some very specific funding opportunities around some specific areas here that I won't go through in detail, but for aged care, for women leadership roles, and for the tech industry, and specifically video game development, there's some specific boosts. So please, if you're in those industries, reach out. We'll have a good chat about it at a one-on-one level.
Thanks, Stewie.
Okay, Paul.
So, company lost Carryback, which is a fairly new scheme. So it was introduced last year, which effectively what it means is if you've paid tax in the last couple of years in your company tax return and then record a loss in, say, the 2021 tax year, you can get a refund of some of the tax that you've paid previously, depending on the level of the loss. And we're seeing that occur with what we spoke about before with the immediate write-off and the ability to write off small business asset pools. So businesses are still quite profitable from an accounting perspective, but from a tax perspective, they're reporting a loss. So it's a good measure where we get access to previously paid tax if the franking account allows that to happen, to get refunded in company tax returns. And what has occurred in the budget, that's now been extended for a further 12 months. So it's also applicable for the 2022 financial year. Again, as Stu touched on before, don't go spend money for the sake of spending money. There's got to be a justifiable reason to do it other than a tax reason to ensure it's money that's going to good use in your business.
Fantastic. Thanks, Paul. I'll cover off on some more very specific items around housing support. So there's a package release for single and at-risk parents, giving the opportunity to get into the housing market through some subsidies. There's changes to the first home saver system, which is effectively a savings regime and the ability to pull some money out of super, but very specific. And if that applies to you, feel free to sing out. And changes to the downsizer limits for those of you who are selling the family home and downsizing, how much they contribute that to super. There's a lot of data that's relevant only at the individual level. So if you think any of them apply to you, feel free to reach out to one of the advisors in the team. Okay, Paul, over to you for the state budget.
Okay, Dan the man, I suppose is what they'd say, and I'm tipping they're quite busy dealing with other things right now, given the news of recent days. So, but we're not here to talk about that. We'll stick to tax and budget and those sorts of things. Happy though to chat offline if you want to in that space. So one of the big highlights that come out of the state budget was around a levy on employers with a payroll effectively above $10 million. There'll be an extra 0.5% increase in their payroll tax rates to go towards a mental health and wellbeing levy to fund, and I think the figure was in excess of $3 billion over the coming years to tackle things in the mental health and wellbeing space. I will chat more about payroll tax specifically a little bit later, Stu, so I'm going to throw over to you to another one that's a very interesting announcement.
This is the most interesting one that I've heard of out of both budgets, and I'm really keen to see how it plays out. Pushing a windfall tax for up to 50% on planning decisions for rezoned land. So the details are a little bit thin, but from our understanding, if you own land in a rural zone that's today worth $1 million, if it's rezoned tomorrow to be a residential zone and that value increases to $5 million, there's going to be a tax impact from the state government on that gain. Really, really keen to see how this is practically applied because, being in a key growth area, and I'm just hoping that it doesn't pass on to land prices around here, which, as I'm sure a lot of people have seen, have had a sharp increase recently. So this is a very much watch this space area on what they're going to potentially tax people on just increasing the value of their land. Paul, back to you.
I look forward to chatting about that one more, Stu, when we find out more, because it's going to impact a lot of people along the supply chain, right from
certainly
from farmers right down to the end user and then builders as well. So, which we know is driving our economy considerably. Land tax, so stamp duty. Effectively, there's been some changes around here at the top end of the market. So property prices where they're selling for above $2 million, the stamp duty rate was 5.5% on sales of $2 million. So anything over that is now increased by 0.5% to 6%. So 110K is the baseline on a $2 million property sale, and then anything over that, there's an additional 6%, so it's a 0.5% increase. On the reverse, there is some duties that have been relaxed in the city to encourage building in the city of Melbourne. So this is not based on, say, Metro Melbourne's announcement around COVID. This is around just inner Melbourne, so the city of Melbourne. There's a 50% concession on stamp duty on new residential property, and if it's sold after 12 months, it's actually sort of 100%. So you sort of got that 12-month period. So if you're stuck there not selling it in 12 months time, you would actually pay no stamp duty in that space. It's an interesting one. I didn't see that one coming, Stu, when that came out of the budget.
It's a very strange one, and it leads really well into the next point here, because there's some other concessions around specifically off the plan builds right in that middle of Melbourne area. So we won't go through the details now because there's lots of back and forth. But if you're looking at something, an investment, or to move down the city and looking at an off the plan build in predominantly in those high rises, feel free to sing out. We'll try and get as much info across as we can. The last one for me here is an increase in land tax on property over $1.8 million. So if you're valued between 1.8 million and 3 million, you'll get a 0.25% increase on your land tax rate. And if you're over $3 million, it's going to be a 0.3% increase. So state government spent a lot of money and they're doing a bit to claw some of that back now. Okay, Paul, payroll tax.
Thanks, Stu. And yeah, you can see with those property changes, it is aimed at the higher value properties. So they haven't attacked those with smaller transaction properties and at lower value. So I suppose that's one positive out of what was a ordinary state budget, in my opinion. Payroll tax concessions, probably the only big one though that I'm quite happy to talk about, being based in a regional area and working with many regional clients, is payroll tax is one of those taxes that when a client asks why we've got to pay it, I can't really give them a reason except to add to the state government's coffers to pay for some bills, and it's a penalty on employing is what we see. So a couple of things have changed there. So the threshold's gone up from 650,000 before it kicks in to 700,000 from July 2021. And then also over the next couple of years for regional businesses, so those, and it's a list of shires, so this does sort of run on the COVID rules when we had lockdown though, so that's how they identified regional shires in that space. Was currently that rate's 2.02%. That does come down for the 2022 financial year to 1.62%. And then from July 2022, at regional rate comes down to that figure that's on the screen, so 1.1215%. Those in metro areas are still paying at 4.85%. So it is a significant discount and an encouragement to see businesses continue to locate themselves out in regional areas. So as I said, pretty ordinary budget though. This is one positive that came out of it, especially for regional employers.
Yeah, it's a big win for areas like ours, Paul. It's going to be great. Hopefully it does see some further investment coming out this way and some jobs growth. So.
And that added with the stamp duty concessions that aren't in the budget that we've heard about, Stewie, so around commercial, industrial property where there's a 50% stamp duty concession available for property transactions. That again helps growth in regional areas.
Yeah, fantastic. All right, well, thank you very much for that, Paul. There's plenty of things in both budgets and some important areas that we should look at approaching year end. And that's where we want to touch on some of the tax planning considerations that we should be making now so that we can get an ideal result come 30 June 2021 and plan out things for how the lodgement cycle is going to roll for the next financial year. So as we've touched on, asset purchases and you can make the call about if you need an asset and taking advantage of the timing difference. So there is a 1% difference if you buy this year compared to next year from a tax deductibility point of view. And if there is something on the cards, it's a good way to decrease that taxable income level. There's also some changes to the prepayments rules. They've opened up some changes for small business. So you can look to prepay invoices in this financial year and claim the tax deduction now for something that you know you're going to need in the next year. We can have a really good look at the superannuation carry forward rules. So look to put in a deductible superannuation contribution before year end. And then if there's room from a previous year's contribution cap, you can also look to bring that forward and effectively claim more a double tax deduction this year. All them sort of combined, or with say the company loss carryback, can be a really good way to reduce taxable income levels and access some tax we paid in the past using that company loss carryback rule, as Paul mentioned before. So you combine those top four there. It's a really good time to make some strategic decisions around spending, as long as cash flow is going to allow you to do so. And then, our final consideration is looking to see if we're in the right entity. As corporate tax rates keep coming down, we've got some people who operate out of, say, trading trusts or companies, partnerships and as sole traders. It can be a good time to take advantage of those corporate tax rates, move yourself across to a company, as well as just look at your overall structure and see what mix can be done and what we can do before year end to get a good result. So those, if you've already got a tax planning meeting booked in with your advisor, that's great. We can go through these items then. Otherwise, feel free to reach out and see if it's something that really applies to you and if you should come in and have a detailed chat.
Thanks, Stu. And I've got the pleasure of facilitating questions, and I have had two come through, and also it's opportunity for any others online or those that have posted questions to keep posting those. So I'm gonna start with one around the prepayment rules, Stu. Yep. So the question here is that the client here runs a business that turns over about $25 million per year. So prepayment rules are new to them. They have had a pretty good year, and they want to know what things they can prepay and I suppose what's eligible for prepayment, and are they eligible at $25 million given they never used to be?
Yeah, so the threshold's moved from $10 million up to $50 million now for the prepayment rules to kick in. So yep, at $25 million, I believe they'd be eligible to apply those. The prepayment rules will allow you to allowable income or expenditure for your business that doesn't go out for more than 12 months. So say, I've gone blank for a good example here. Say you're a farmer, you've got a fertiliser bill you want to prepay, you're going to use it over the next 12 months. Go ahead, prepay it, claim deduction now. The old one, the prepaid accounting fees. I know that's one that's plugged in our industry. That can be one as well.
It's always a good one. See that happen quite often, isn't it, Stu?
Yeah, it's a great one. Yep.
And if you really want to get on side with your landlord as well, have a chat to them. They might prepay rent, and they might also be able to lock it in at the prior year rate too before your next CPI rise. We are seeing some landlords be quite generous out there. We know cash is sitting in business from government stimulus over the last 12 to 15 months, earning no interest, even with debt rates where they're at, even sitting in an OD. The OD is probably at 3 or 4% anyway. So there is some advantages there if you've got cash available to look at those things. So good answer, and thanks for sharing that, Stu. Now, just the other question was around that asset purchases, and just wanted to reconfirm the timing. So someone ordering something now, but they've been told it won't arrive till September. It meets the rules though, so it's under 150 grand. Can you take us through again how that is deductible and when that is deductible?
Yeah, so capital purchase is deductible when it's available for use. So it's got to hit the ground and be operational before you can claim that deduction. So if you've ordered today, you've got your invoice today, but it's still sitting on a boat, stuck in the Panama Canal somewhere, then it's not until it gets here that you're going to be able to claim that deduction.
Yes. Yeah. Thanks for clarifying, Stu. And this question was around a vehicle, and also just mindful of the the depreciation cost limit too on vehicles. Not going to put you on the spot, Stu, to read out the exact dollar figure, but always work on it. It's around 60 grand. Anything over 60 grand, and if it meets like a genuine motor vehicle, so it's not a over 1 ton capacity and those sorts of things, you can't claim the GST or the depreciation, so the immediate write-off on the value above that 60 grand. So you go buy, say, something for 100 grand that doesn't have the carrying capacity, so it's a motor vehicle for the depreciation cost limits. You're only getting a deduction for just under 60k. So just wanted to clarify that there. And car salesmen won't care. They'll just get the sale done and they'll tell you it's fully tax deductible, and they'll leave us to be the bearers of bad news. So do your homework before you go out and buy vehicles if you're looking to try and write them off completely, and also be mindful of fringe benefits tax and those sorts of things as well, and considerations in that space.
Yep. Certainly check in, ask the question, and as Paul said, there's certain cars out there where there is that 6 month waiting list at a minimum. I think there's, depending on the car, it can be even a bit longer than that. So, yep, you should have plenty of time to ask a question before.
And no other questions have popped up, Stu, so you've been let off, I think, very lightly.
Yeah, thank you, everybody.
And I didn't actually prepare any questions myself, and so next time you're on the screen, I actually will, and I'll make sure that they're tough ones. So thank you for answering those 2 questions. I know that the clients are appreciative of that feedback, and in that, thank you for leading today's discussion, Stu. Thank you, everyone, for joining us today and hearing about, I know it's a boring topic, but it's an important topic around state and federal budgets and what that means for you, your business, your employees, your family and friends. And yeah, everyone take care and stay safe. We'll all be watching the news over the next couple of days to see what it does mean for ourselves, both personally and professionally in the business space. So thanks again, and we'll chat again soon.
No worries. Thanks for joining us today, Paul. Thank you, everybody. Great talking to you, and I'm sure we'll catch up with everyone soon. Cheers.
Bye.